to build the knowledge base. So this is our initiative, what we've been doing on every Friday evening. So today we have Mr. Mayur Patel with us, who is the equity fund manager at IIFL Mutual Fund. So he's our guest speaker today. And we have Mr. Shikhar Singh from Groww to talk about the Groww product and the platform. Okay, and I myself, Karthik. So now, when it comes to the matter of topic, right, I think it's always good to go back to basics once in a while, okay? So today's topic is on how to pick mutual fund schemes for long-term SIPs. So we are basically talking about equities primarily, and then how do you handle equity SIPs, and then what should be the purpose behind them, and so on. Okay, so let me just share the presentation in the meantime. Okay, so see, generally every time we think of equities, right, especially for a first-time investor, the word equity itself might lead to a lot of interesting conclusions. Like the moment you think of equity, people might perceive it as very risky or volatile, or it's only optional, it is not a compulsion, and so on. Okay, so let's look at equity as an investment option from a slightly different perspective. Okay, so why should we invest in equity at all? Okay, why can't we just live for today, or and just try to manage the investments for our foreseeable future? So what is the driving force behind investing at all? Like forget equity for the time being. I mean, it could be investing in any other investment options, normally what we think of. So the question is, why should we invest? What is the driving factor behind investment? So that's the fundamental factor what I would love to address it today. So the aspirational aspect, is on that before you start putting your money, okay, or even if you've already been investing, maybe take a step back and then do this one interesting exercise, that prepare your own list of financial goals. Okay, it's very essential that every investor should have their own financial goals. Okay, so what is a financial goal? Anything which needs money in a foreseeable future. Okay, it could be your own vacation, or buying a car, buying a house. Suppose if you're married, then maybe children's higher education, children's marriage, or your own retirement. All these are examples of financial goals. Okay, but for us to call any of these things as a financial goal, you need to define it with time and money, which means, okay, I'm planning to buy a house in 5 years, and the cost of the house would be, say, 60 lakh rupees. Only then it could be called as a financial goal. Okay, so that's the aspect what you should keep in mind. And once the list of financial goals are ready, it's important for you to prioritize them. Okay, for example, buying a brand new phone versus children higher education, which one should be of higher priority? The moment I ask a question like this, children higher education sound like a very serious goal. Most of you would start leaning towards children higher education. But take a step back and ask yourself this question: are you married? Do you have kids? If you're not married, you don't have kids, then you don't have to worry about children's education. Maybe worry about buying a new phone which you think you can afford. So prioritizing the financial goals is completely dependent on your current life stage you are in, and how much investments or portfolio you've already built, your risk appetite, and so on, various other factors. Okay, but amongst all the goals what I have mentioned, if you'd ask me, one of the most important financial goal, irrespective of how old you are, retirement should be one of the most important financial goal. That means approximately it should be on top of your list. So you must be thinking, Arey, why should we worry about retirement? Especially if you're in your 20s, okay? You must be thinking that, Arey, I still have 25, 30 years to go for my retirement. I'll think about it later. Let me buy a phone or go for a vacation. I'll fulfill all these goals which are really upcoming in the near future. So one is, as individuals, we are living longer. As Indians, if you see, over last 30 years, our life expectancy is increasing, and it is expected to go up further, for sure. Today, the life expectancy is about 70, but in the coming 30 years, 40 years down the line, the life expectancy could be as high as 80, 85, or maybe 90 years as well. So how will this play out for us? Suppose if you are an individual, okay, your age is 25 years, and if your monthly expenditure is 40,000 rupees per month, okay, That's what you're spending today, your lifestyle. And we are assuming inflation of 6%. What do you mean by inflation of 6%? If you're spending 100 rupees today to maintain the same standard of living, next year you need 106 rupees. What is happening? The expenses are going up, or the value of your money is coming down. So if you keep just the same equation, what is happening? When you turn 55, I'm assuming you would retire by the age of 55, you would need about 2.3 lakh rupees per month to maintain today's standard of living. So when you think of retiring at the age of 55, I'm not saying you're going to sit at home and do nothing from the age of 55 onwards. All I'm just trying to say is after 55 or maybe 60, you don't want to be worried about money. You should have enough money to take care of rest of your life. Okay. Now, if this is the expenses, what is required per month starting from 55, and if you were to live till 85 years, take a guess how much money you need to have in hand. If you were to manage your expenses till 85, and that to inflation adjusted expenses, approximately you need to have 5.6 crore rupees in hand. Okay, so you need to have 5.6 crores in hand at the age of 55 so that you can manage your life till 85 without having to worry about inflation. Every year you can keep on increase your withdrawal to match up with inflation. So that is why I think retirement is one of the very important financial goals, because if you need 5.6 crores, you can't think of it when you turn 55. You should start planning from it from today itself. So this is what we would say, that identifying or defining your aspirations or defining the problem and then start working backwards. So now since you know, acha, 5.6 crores is what you need for your retirement, now how are you going to achieve it? Suppose if the same individual says, look, I don't like equity because they're risky, okay, and returns are not guaranteed. These are some of the standard answers what people come up with. Okay, if that's the case, I would say, okay, fine, try investing in debt portfolio. That means complete debt portfolio, combination of debt funds, FD, and so on. In that case, to get to this 5.6 crores, this individual would have to invest approximately 40,000 rupees per month. Okay, the same thing, and through equity mutual funds via SIP would have to start with 12,000 rupees per month. Look at the difference. Where is 12,000 rupees per month in equity, whereas 40,000 rupees per month in debt portfolio? So essentially, what I'm trying to tell you is, for long-term financial goals, equity is not an option. It is a necessity, right? You don't even have to start with 12,000 rupees. If you start with step up SIP concept, maybe you can start with 6,000 rupees now and then increase it by 10% every year. You would still approximately get to the similar corpus of 5.6 crores. So let's understand one thing. If you have any long-term financial goal, and if you're intending to achieve it, then equity mutual funds and SIPs into them is the best way, or probably easier way, for you to achieve that financial goal. So it is like saying, from Bangalore, if you want to travel to Delhi, the fastest and the quickest mode of transport is air, by air. So it would make you reach in 2.5 hours, but any other mode of transport will take you longer. That's the essence what you need to keep in mind. So if that's the case, then how are you going to decide your asset allocation? So we started our session with financial goals. So you divide all your financial goals into three parts: short term, medium term, and long term. So you wanted to buy a phone in next 6 months, that is your short term financial goal. You want to buy a car or change other car in next 2 years, that is your short term financial goal, because you're intending to achieve them within 3 years. Medium term ballpark definition could be between 3 to 7 years. You're planning to buy a house in 5 years, that is your medium term financial goal. And for long term financial goals, it could be safely assumed 7 years and above could be considered as long term financial goals. So for short term, to achieve short term financial goals, whatever money you are saving and investing, that should be in complete debt portfolio, which means essentially no exposure to equity whatsoever. In medium term financial goals, to achieve them, you could look at investing in hybrid mutual fund schemes. And for long term financial goals, essentially majority of your money gets into equity. Okay, so you could look at a ratio of 80-20, 80% in gold, 80% in equities in the form of mutual fund SIPs, and then 20% in gold. So that's the broader allocation strategy you should keep in mind. before you start putting in the money. Okay, because if you don't have a direction, that means if you don't have a destination in mind, which road you will take itself could be confusing. So that's how you should ideally look at. So then, once you really look at these goals, you define them, you decided, okay, now to achieve long-term financial goals, maybe like you want to start your own business in 10 years, you want to retire in next 25, 30 years. Once all those things are done, you need to understand the basic nature of mutual fund schemes, especially equity mutual fund schemes. So all of us, while selecting the equity mutual funds, we look at the returns. Okay. Generally, how do we look at returns? We go and search in the internet, last 1 year best performing funds, or maybe last 3 years best performing funds. But I personally think just last 1 year performance or last 2, 3 years performance may not give you the complete correct picture of the fund. Slightly longer history would give you an idea about how much return you could take and what do you mean by volatility and also all those things. And also, you also need to look at what is the risk involved in the mutual fund schemes, because it is not just about getting the returns, it is also about how much risk involved. Okay. Now, to talk about returns, we always should look at CAGR, and that too a long-term returns, not just last 1 year or last 6 months performance. So if I told you that Sensex generated, say, 16% approximate CAGR from calendar year 2003 till 2020, does it mean that every year you would have got same 16% return? Not necessary, right? Some years you would have got more, some years you would have got less, which works out as on an average 16%. Look at this example. Calendar year performance on that year. What is the return generated by Sensex? So Sensex is one of the leading indicator. So look at 2003 or 2009 are the years where you got those astronomical returns, and again 2005, 6, 7 also you got great returns. But at the same time, 2008 or 2011 you were in negative return zone. With all the ups and downs, your average return is working out to 16% per annum. So I'm not trying to tell you that set your expectation at 16, maybe set your expectation on equities maybe at 12%, but at the same time, do not expect same 12% return every year. Be open for the volatility. Okay, that is how equity would work. That's the essence of looking at equity returns. Okay, the second one, how do you measure the risk? Okay, now when we look at risk in a nutshell, the risk involved in mutual fund schemes should ideally be lesser. Now, when you're comparing different mutual fund schemes, you should say, acha, a fund with a lower risk is better. Okay. And at the same time, risk adjust the returns. That means what is the return generated by the fund after adjusting the risk? So these are the two other factors what you should also consider while selecting a mutual fund scheme. So it is like saying Bombay to Pune on the highway. If you were to travel by the road, it might take, say, 2.5 hours to reach, or maybe 3 hours to reach. But if I told you, look, I reached Bombay to Pune within 1 hour 15 minutes, then you would say, okay, fantastic. But at the same time, the first question what you would ask me is at what speed I traveled. If I told you 180, 190 kilometers per hour in my own car, then you would say that I might have reached one time, but I may not reach every time safely, because at the same time, it's not just about reaching the destination. It's about how safely you're going to reach. Okay, that's what you look at risk and risk adjusted returns for. So just to give you a very simple and interesting comparison here, I've just chosen broadly most of the multi-cap funds. Okay, like I said, standard deviation is the risk measurement tool. So you select a fund with a lower risk, and Sharpe ratio gives you risk adjusted return. That means higher the ratio, better the fund is. So if you look at these, like let's say 5 funds which are there, last 2 funds carries least standard deviation here. At the same time, a higher risk adjusted return. So that's how you start comparing the funds and then start picking up the funds. I'm not saying this is the only factor what you should look at, but this is definitely one of the factors you should take into consideration. Okay. Now, coming back to the topic with respect to SIPs, why SIPs are good. I'm sure all of you are aware of SIPs. I don't think you would not have any idea about SIPs, but why SIPs are good, and especially in markets like this, how SIPs would handle your risk of the portfolio in a better way. Okay. So in a nutshell, all we are just trying to say, SIP is nothing but a mode of investment. It is not a fund itself. There is a myth that people assume SIP is different from that of mutual funds. No, SIP is only a mode of investment into the selected scheme of your choice. So you decide how much you want to invest every month, maybe 2,000, 5,000, 10,000, how much ever you want. And you also need to select the scheme. Okay. XYZ multi-cap fund, ABC large cap fund. You chose the fund. And then once you choose the fund, what happens is on a regular basis, the money will be deducted from your bank account and it would be invested into the scheme of your choice on the date what you have decided. Okay. If there is any specific issues with respect to date, and then if it is getting deducted early or on a later date, definitely there is something what you will have to check with your bank. But remember, whenever you do any investments, whether it is through SIP or one-time investments, it doesn't go to the intermediary. The money goes to the fund directly. The very interesting advantage of SIP is it helps you in bringing in discipline in your investment process. You start investing small amounts of money, but you keep accumulating more and more units. Okay. It's like when you keep buying gold, you keep accumulating grams in terms of units. But if you have to do the same exercise for 10 years, the number of grams of gold what you would have got would be phenomenal. Okay. So this is the whole concept of SIP. We say the traditional advantage is rupee cost averaging. Okay. So here it is. I'm just taking a small example of a particular investment example. Say 1st February, you started your SIP for the period of 5 months. What if markets are coming down? Suppose you started your SIP today. From today, what if markets are going down? What is the advantage? Every time you purchase an SIP when markets are going down, the number of units what you start holding would go up. If you see in the month of January, for same 1,000 rupees, NAV of the fund was 25, you got 40 units. Whereas in March, 1,000 rupee invested, but the NAV of the fund was 17. Instead of 40 units, you got 59 units. So technically, you almost got 337 units in hand. So this is what happens in the falling markets. Number of units what you hold would actually go up. But what if it is opposite? Like what if markets are going up from here? Same thing if markets were to go up from here, the advantage what happens is the average cost. Okay, the cost of your holding would actually come down. If you see January, the cost price was 25, that is per unit price. Whereas in 1st May, the per unit price was 50. But by doing SIP for 5 months, your average cost, or we call it as weighted average cost, is 37 rupees. So that's the benefit what you get by investing in the form of SIPs. But the true advantage of SIP is what we call it as power of compounding. I'm sure all of you would have seen different calculators, different examples. To put it in a just interesting perspective, also lead you to the next concept. Suppose if you invest 3,000 rupees every month, and if the fund gave you 12% return for next 30 years, that is 360 months, okay, 12% per annum, remember, you would almost have 1 crore in hand at the end of 30 years. When you look at such big examples, which lead you to great wealth creation results, people always have doubts. What's the guarantee that this fund will give you 12% return at all? Or my portfolio would give 12% return at all? I'm just going to show you, a journey of a particular mutual fund scheme. You can see something like this in almost every scheme. Okay, I'm not saying every scheme will give you same results, but you would always have the difference. But I'm saying similar journey. Okay, so there was this particular scheme which was launched in the year 1995 January. At that time, per unit price was rupees 10. Okay. Suppose you invested today, January 1995, per unit price was 10. But January 1997, per unit price was 5 rupees 63 paise. Imagine if you had invested 1 lakh rupees, you would have lost 40,000 rupees in 2 years. And today it is worth only approximately 56,000 rupees. What would you do? Many people would say, let's withdraw. That's what people did in the past. Now people are saying, let's wait. But the right thing to do is when markets go down, that's an opportunity or a great opportunity for you to buy. Had you held on to your investments till January 2000, that is 5 years from the date of your investment, the value would have been 25 rupees. 2.5 times returns, that 1 lakh rupee would have become 25 lakh rupees. This is where most of the people would say, let's withdraw now. Now we've got great return. That's what most of the people were thinking till the time Sensex reached 50,000. I think we've made great returns, let's withdraw. Because we tend to respond emotionally for every movement in the market. But had you just held on to this investment till January 2008, okay, that is in 8 years from this 25 rupees, the per unit price would have been 224. Look at this, over a period of 13 years, you've seen the journey 10 rupees moving with all the ups and downs reaching to 24 rupees. That 1 lakh rupee would be worth 22.5 lakh rupees. And as of January 2021, that is approximately around today, the per unit price is 739. So equity always helps you in long-term wealth creation. That is what you need to understand. Short-term volatility will always be there. The reason why I'm showing this example because of one very important learning. When markets go down, don't be too upset. Okay, put in more money. But at the same time, markets go up, don't get too carried away. Stick to your financial goals. Many people ask me this question: when should I withdraw the money or when should I redeem the money? I've made great returns. Is this the time to withdraw? The correct way to redeem the money would be that if you're almost reaching your financial goal, that's the time. Suppose if the goal is about 1 year away from today, 2022, you're planning to buy a house and you're doing your SIP since last 7-8 years for to achieve this goal. This is the time you slowly start doing the SWP or STP into a debt mutual fund scheme. Okay, it's like you are on a highway, you want to take an exit. Keep coming towards left slowly and take the bypass and take an exit. That's the right way to exit from the fund when you are specifically goal based. If there is no specific goal and if you don't need this money for maybe another 8-10 years, then I would strongly recommend continue investing, because today's new heights may not be new heights 10 years down the line. Okay, so how do you construct the portfolio of equity funds? Not, let's take similar scenario. There is this guy by name Groww who is 32-year-old, working in a tech firm, planning to retire at the age of 55. He's ready to invest 15,000 rupees per month to achieve retirement as a financial goal. So which fund should Groww invest? That's what most of us would think. I'm okay to invest this money for 10 years. How do I invest in a fund? What we ask in every expert we meet is, sir, tell me what is that one best performing fund I'll invest my money. Okay. So it is like saying you want to bet all your money on Virat Kohli's performance or maybe on, say, Cheteshwar Pujara's performance. Ideally, that should not be the case. You should always have a nice basket of funds. Okay, that's what we call it as all the equity mutual funds put together. You can divide them into two parts: core portfolio funds and satellite portfolio funds. Anywhere between 65 to 85% of your money could go into core portfolio. That is, a core portfolio is like an all-season fund. Like you should ideally be invested. Don't worry about timing the market. Just continue your SIPs. Satellite portfolio is is where you make these smaller changes, take advantage of the market timings or market sectors and so on. So what are the funds which would form part of core portfolio? Large cap funds and index funds would definitely be part of core portfolio. Multi-cap funds, ELSS funds, and the variants of multi-cap funds, like focus funds or value funds are also could be part of core portfolio funds, and then mid-cap definitely. So these 4 or 5 category of funds is something what all of you should have in your portfolio. Okay, and always remember to create a basket, because not every time the funds what you've invested, or not all the funds would be performing really well. Some funds in some years would be lagging behind and some funds would be really ahead. But this is what we call it as balancing out, because next year, this year's fund, the lagging fund would be the best performing fund next year. So ideally, your SIP should continue in core portfolio. Okay, select these funds, create a basket, and then continue. But at the same time, if you have only 500 rupees to invest, you don't intend to invest anymore. Maybe just pick up one fund. Maybe a good multi-cap fund of your choice should be good. Okay, and if you have any short-term view, I think with all the economic recovery, I think so and so sector is expected to do well. That maybe with a small amount of money, you can take an exposure in your satellite portfolio. Okay. So on that note, I would like to conclude my side of the presentation. Okay. I would like to invite Mr. Mayur to take up from here.
Thank you, Karthik. Very good afternoon, everyone. This is Mayur Patel from IIFL AMC. I'm working here as a fund manager, managing the IIFL focused strategy. So I'm going to speak on focused equity mutual fund as a category. I'm not talking about any specific fund, but trying to describe what is focused equity mutual fund strategy, its characteristics, some positives, and trying to question certain general perception about diversification. So starting off, it's very simple. Focus equity mutual fund strategy is a concentrated fund investing into limited number of stocks with a maximum limit of 30 stocks and a regulatory requirement of investing at least 65% of the fund into equity and equity related instruments. So it's largely a focused equity mutual fund with a option with a view to invest in multi-cap stocks. Has multiple benefits. So let me just touch upon a couple of these positives. So the core part of the fund, or you can say the core characteristic of a focus strategy is the concentration. So these are usually you'll find 25 to 30 stock portfolios in any of the focus equity mutual fund strategy, as compared to a multi-cap category where you'll find 40 to 60 stocks. There would be few funds which would be on a lower side, but generally you'll find a much larger base of companies or much wider basket as compared to focus. So there's a core differentiation in a focus strategy. Now coming to the positives, most of the focus funds are adopting a bottom-up kind of strategy. If you look at their overall portfolio construct, it's more driven by a bottom-up security selection rather than more top-down, right? So that's one characteristic. And since it is a 25-30 stock portfolio, not a 60-70 stock portfolio, the entire research bandwidth of the fund manager and the related research analysts are focused on these 25-30 stocks. So the research depth per company increases manifold as compared to a much wider basket, much fund with a 60 to 70 stock portfolio, right? So with that kind of depth, fund manager is able to, have much more conviction behind each and every position and can have a sizable weight behind individual companies in the portfolio to capture maximum outperformance out of the entire effort on the research side on that particular idea in the portfolio. So moving on, another interesting aspect is since it's a concentrated fund, limited bullets to fire. So the fund manager and the research team is pushed to narrow down their top picks in every industry to maybe one or two, right? So the best among your top ideas get reflected with a very large weight in a focus strategy. So again, the fund benefits out of the most highest conviction ideas in the research basket of that fund house. So that's another positive of a focus strategy. Last but not the least is the flexibility which a fund manager gets in a focus strategy to allocate the fund between large cap, mid cap, and small cap based on the fund manager's view on the risk reward in the individual these segments. So I'll describe this point in much more detail in subsequent slides, but there are no restrictions, regulatory constraints in terms of X percentage only maximum you can put it in a large cap or Y in mid cap and Z in small cap segments, right? So this flexibility can, it enables the fund manager to put more money behind a particular market cap segment where the risk reward is best, and hence work towards improving works through the best interest of the end investors. So I'll describe this in a while, but so that's the left hand side of the slide, which I was talking about the positives about the focused equity strategy. The right hand side of the slide is more on the diversification. So it's a very simple graph plotted, and again based on many papers, theories, and articles written by global investment professionals. There is a view, again, there is no such proven thing, but again, I belong to that camp who believes that diversification benefits reduces significantly once you cross 25 to 30 stocks, right? So to keep it simple, there is in the equity instrument, return is one aspect, but like Karthik explained in the previous presentation, what risk are you taking is the most important part, and how to reduce this risk. So there's a general perception that by increasing number of stocks in the portfolio, you can reduce risk. Now, I have some question marks on that, and I'll come to that. So what I'm saying is, if there's a portfolio is having a 10 stock and a portfolio is having a 25 stock, the risk reduction which you can achieve by moving from a 10 stock portfolio to a 25 stock portfolio, 25 stocks portfolio, is significant, right? But beyond that, there is an inherent amount of market risk which cannot be eliminated. So what happens is, when you move from 25 stocks portfolio to a 50 stocks portfolio, the incremental benefit of diversification goes down significantly, and hence it's kind of I'm questioning the general perception that a 60-70 stock portfolio can give you much better diversification as compared to a 30 stock portfolio, and can reduce risk significantly. So that's the point I was trying to make. So moving on, so again, coming to the point of flexibility, which I was talking about on the left-hand side, the next two slides are created to describe that. So this is a graph of P, price to earning valuation ratio of Nifty large cap index, NSE mid cap 100 in sorry, mid cap index, and a small cap index. So if you see 2016 and 17, mid cap and small caps outperformed large cap by a wider margin. And in December 2017, these segments peaked out. So this was the time a fund manager could have taken a call to that risk rewards are not attractive in small and mid caps, and it's wiser to allocate more money to large caps where the risk rewards are much more interesting. As say, for example, the mid cap index was trading at a 40% premium to large caps, which is much above the long-term mean. So in a focus strategy, a fund manager has that flexibility to reduce the allocation from small and mid caps in the portfolio and divert it towards large caps where the risk rewards are looking much more interesting, right? Similar, if you go further ahead, look at the graph, December 17 to December 19, these small and mid caps indices underperformed significantly. And this was a time so what I'm trying to say, in market sometimes gives you extreme situations where risk reward becomes really attractive, and in certain buckets, the risk reward becomes very unattractive. Sometimes you get these kind of situations where it warrants a kind of change in allocation to some extent between these buckets. And you can do that. The fund manager, for focus strategy, has the flexibility to change the allocation a little bit towards better risk reward buckets, and obviously in the best interest of the end investor. So he could have increased the small and mid cap component in the focus strategy around December 19 or so, and it's purely a fund manager's decision. But what I'm trying to say is the one message: different market cap segments outperform over different periods, and the focus strategy has the flexibility to take decisions in terms of changing allocation wherever required. Now, to just moving on, this slide is also talking about the same point, but from a different perspective. If you look at so these are the average. So in the previous slide, we were talking about the PE valuation of different indices. Here, we are trying to we have plotted the average returns of all the large cap schemes, most of the large cap schemes, mid cap schemes. And so every category, we have plotted the average returns in individual years. So you can clearly see the outperformance in green and the underperformance in red. So again, highlighting just the same point that different market capitalization segments outperform over different periods, right? So if you look at the focus scheme over last 5 years, it has been one of the best performing category. I'm not saying this always be the case, but last 5 years has been quite good for focus as a category, and it has all the ingredient if to get the best out of a lot of other categories, and which is evident in terms of because people keep highlighting that focus as a category is extremely risky because of the concentration. But if you look at the risk parameters, if you look at the 12.27 standard deviation, it's the average of all the focus on the rolling returns of 5 years, is slightly higher than large caps, but significantly lower than the mid and small categories, at the same time delivering good outperformance. So on a risk-adjusted basis, it is looking quite good. So just to conclude on all these slides, what I'm trying to say is different market segments outperform over different periods, and the focus category, the fund manager of focus category has that flexibility to take decisions, to change allocations, and to create an optimum mix, which is in the best interest of the end investor. So yeah, that's the moot message out of these two slides. Moving on. So this is an interesting slide, not specific to focused equity as a category, but it's more applicable to general equity investing, any kind of equity investing, which Karthik covered it to a great extent. This is very important and very interesting. So we did this analysis over last 20 years, where we have plotted rolling returns for different time frames. For 1 year time frame, rolling returns for 20 years, 2 year time frame, 3 year, 5, 7, and 10, and plotted the median Sensex returns for these time frame buckets, and also plotted the corresponding risk parameter, which is the standard deviation for the same buckets. So keeping it simple, not getting into too many technical terms, just want to explain this slide with an example. So if there are two investors, one taking a 1 year view and another taking a 6 year view, both are investing in an equity market. So this investor A, who is taking a 1 year view, over last 20 years, he can enter any time over last 20 years. There is a 50% probability that he will earn more than 13% return if he's investing in a Sensex related instrument, just the broad large cap index. And the risk associated with that potential 13% plus return is around 36%, which is pretty high. So there's a 36% volatility involved in that expected 13% return. Right? So if you try to plot in a layman's way, return per risk is quite poor. Similarly, investor B, if he is investing with a 6 year view at any point of time over last 20 years, there is a 50% probability that he will earn around 11-12% plus kind of returns, which is very close to what investor A was expecting. But with only 12-13% kind of volatility. That's the standard deviation. Right? So that's the only risk he's taking for this 12% kind of expected return when the time frame is 6 years, and this could be any time or last 20 years, right? So clearly, when anyone is investing in the Indian equity market, it makes the overall case is very weak to invest in the equity market if you're taking a 1 year view. And it becomes really attractive on a risk adjusted basis if you're taking a 5 to 6 years view. So that's the simple message which I wanted you guys to take home out of this slide. Now, since we are talking about focused equity mutual fund as a strategy, and I described the features, characteristics, positives, and one slide on the long-term investing. So this is just one illustrative example of how the focus fund looks like. This is IIFL focus funds, some of the attributes. So 68% in large cap. It has 19% in mid caps, 10% in small caps. It has around 29-30 stocks. Most of the time it remains around that level. 30 is anyway the outer limit for a focus strategy. And these are the segments, these are the sectors where the fund has exposure. Just for an illustrative purpose. So with that, it ends my presentation. Happy to take questions, and thank you very much for patient hearing. I hand it over to Shikhar.
Thank you. Thank you so much, Mayur. Welcome to Ab India Karega Invest, everyone. I will be talking to you about the product that Groww is and all the offerings that we have. And later I'll be taking questions regarding the Groww product. And of course, we'll all be taking different questions regarding your investments also. So I will just very quickly start sharing my screen. Yeah. So before I delve into this, I'll very quickly tell you the reason why Groww was started was that investment should become easy for everyone in India, right? In India, we're not very, we Indians are not known to invest in all sorts of options. We invest in a very limited kind of investments. So that was the reason why Groww was started. One of the main reasons. There were a bunch of other reasons too, but this was the main reason, which is to make investing accessible to all. And not just when we say investments, it doesn't mean just a kind of investment, as many kinds of investments as possible, right? So you'll see, because when we started about 4 or 5 years ago, we had only mutual funds, and now we have stocks and we have golds, and we'll have on the certain users have US stocks. We also have FD on the web. So we're trying to, as I said, we're trying to bring in all sorts of investment options on our product. So please have a look at my screen now. When you open the app for the very first time, this is the screen that you'll see, and you'll have the option to log in with your email ID, or if you have a Gmail, you can log in using the Gmail ID, right? Signing up, again, it's super easy, super convenient, doesn't take much time. And if your KYC is not done, we'll get it done. It's all paperless, all done sitting wherever you are. There's no need to send any paperwork or anything like that. It's all happening via a smartphone or laptop. So once you've logged in, this is the first screen you'll see. So right at the top, there's the search bar in which you can enter the name of a mutual fund or stocks. And as you search, they will pop up. Below that, you can see there are 3 tabs. So there's the first tab, which is stocks, second tab, mutual funds, the third tab is gold, right? So in this screen, you're seeing the mutual funds tab. So this is the explore screen. So at the app, in the app, right at the bottom, there are 3 main screens. One is explore, the other is dashboard, and the third is you, right? So when you're on the explore screen, you have these 3 tabs at the top. There's stocks, mutual funds, and gold. So this is what the mutual funds tab looks like. It has collections, popular funds. If you scroll down further, you'll find more such relevant information regarding mutual funds. Likewise, if you go to the stocks tab, you'll get this tab. This is the explore screen for the stock section. So again, you'll find the indices, top gainers, top losers, so on and so forth as you scroll down. And in a similar vein, when you tap on gold, you end up with our gold option. So as of now, there's just one gold option, which is Augmont Digital Gold, and we'll be adding more options in the future, and they'll show up here as you would have guessed. Now let's move to the next section, which is, let's say you type a mutual fund's name, right? What happens after that? Or you select a mutual fund, you tap on it. So what happens after that? You end up on the mutual fund screen. This is what it looks like. In this screen, you will find all the details pertaining to that mutual fund that you could ask for. There's practically no information that you should know as an investor that you won't find here, be it returns, expense ratio, how that mutual fund compares with other mutual funds in the same category, the fund manager's name, so on and so forth. Everything that you should know, you'll find it here. And similarly, if you tap on a stock's name, you'll end up on this kind of a page where again, you will have all possible information with regards to this particular stock on this page. And again, similarly, you have the gold page. Here we have Augmont Digital Gold, and here you'll find all information regarding the digital gold purchase that you can make here. Now, moving on, there's something that many of our investors don't realize is that investments in mutual funds is not only about SIP or monthly investments. There's the one-time option also. You have both options. If you want to make monthly investments, you can go with SIP or SIP. If you don't want to do that, if you want to invest only once, you have the one-time option. It's very convenient. There's no obligation that you have to invest monthly. And further, there's another misconception that we commonly observe is people think if they have started an SIP, they cannot do a one-time investment, or vice versa, which is again not true. Even in the same mutual fund, you can start any number of SIPs, 1, 2, 3, and at the same time do one-time investments in it. So it's all open. There's no restriction. It's not like you invest using a certain method in one fund and then you cannot use any other method. That's not true. You can use any method. You can stack it up, one time plus SIP, all up to you. Now, this is the dashboard screen that I was telling you about earlier. You have dashboard is basically your investments. So the kind of the money that you would have put in, this is the place where you will be able to track it. Again, this too has the 3 tabs at the top. There's stocks, mutual funds, and gold. In the mutual funds, as you would have guessed it, you'll be able to see your mutual fund investments. If you click on any, or rather, if you tap on any of these mutual fund names, you'll be taken to the next screen, which has details of your investments in that mutual fund. So your your folio number, your past transactions, when did you invest, when did you withdraw, how much you invested, how much you withdrew. All of those information will be found when you click on any mutual funds name. Likewise, if you go to stocks, you'll be able to see your stocks investments, and likewise, if you go to the gold one, you'll be able to see your gold investments. So this is the page I was talking to you about. Once you tap on a mutual fund's name, you end up on a screen like this. You have, in this case, they're only invested. This particular investor has not withdrawn anything. But if you had, those would pop up here. Right at the bottom of the screen, you can see there's a sell option and there's an invest more option. So in the same fund, if you want to invest more, you can use the invest more option. And if you want to take out your money, which is redeem or sell, you can press the sell button. You'll be asked to enter the amount that you want to withdraw. And just doing that, just confirming that, your order will get processed. And within 2 to 4 days, working days, your money will reach your bank account. You have all options, payment options on Groww. You can use UPI, net banking, NEFT, RTGS, IMPS. Everything is open. You can use any option you find convenient. Import and switch. So this is probably one of the more popular features we have on Groww. I mean, everything is quite well accepted by our audience, but this is particularly talked about. So import. What does import mean? Import means, in this case, in the case of Groww, it means you can track an investment in mutual funds that you did not make on Groww. So let's say you invested in mutual funds using some other platform or some other option, and you would want it on Groww because it's easier, it's all in one place, all your investments in one place. How can you do that? You can do that using import. Go to your dashboard and scroll right to the bottom, and there you'll see this option, this button called import. You tap that, you will be able to um, import all your mutual funds to Groww. It's very easy, it's very simple, very seamless procedure. You will have to give your email ID, which is linked with those mutual funds, and it's just follow the steps. It's very easy. It takes no time. So once you have those mutual funds on Groww, let's say they were not direct plan mutual funds. Let's say they were regular plan mutual funds in which you were paying a commission, and you'd like to switch. So the switch allows you to do that. So first you import and then you switch to a direct plan. Again, this will all be available on the dashboard once you start importing. Please reach out to us if you have any doubts, any questions, any queries. You can email us at support@groww.in. This is our email ID. And besides this, if you have any other doubt, you can go to the help and support section of our app or website. And in that section, you'll be able to find answers to nearly all of your doubts. If you still have doubts that the help and support section is not able to clear, then you can reach out to us. You can raise a ticket. You can, using a ticket, you can call us, you can email us, you can chat live with us. You have all those options. So that's another way to reach us. Please do follow us on Facebook, Twitter, LinkedIn, and YouTube. If you're a new investor, please do check out the YouTube channel of ours. It's called Groww YouTube channel, where Jagdeep comes every week, and he uploads up to 2 to 3 videos every week where he talks about stocks and mutual funds, mostly about stocks. And it's a very good way to get acquainted with the world of investments. So do check out our YouTube channel. Couple of things more about ourselves. We are one of the highest rated investment apps in India. Practically all mutual funds available on Groww. We have over 1 crore users, and we're SEBI and AMFI registered. We use bank grade security, 256-bit encryption, and we're an ISO certified company. With that, I come to the end of my presentation. Please leave any questions you have. Now we'll start taking questions from all our viewers.
So hi, I think we'll start with the questions. So it was very nice and a fresh perspective on the focused funds. Mr. Mayur got to learn a lot. So the first question is towards you. So how to choose an index fund? What are the parameters an investor should keep in mind while selecting an index fund?
So it's index fund is one of the best ways to have a passive investment and invest directly into any index. So the only simple, since there are no fund managers bias or any style or any stock picking involved, which is or there are no other discretionary factors which differentiates one index fund from other. So the only basic rule is look at the lowest cost index fund. To select that, ideally stick to the larger well-known names, and just mostly you will get the outcome right. Just for your satisfaction, the index in which you wanted to invest, you just plot the returns of that index for some history and just compare the return of this index fund. Ideally should be same after deducting the fees. So if that is the case, then the lowest cost fees index fund you should select.
Sure, that's great. But just to extend that question, suppose if I'm investing 10,000 rupees for an SIP for next 15-20 years, what allocation you think is recommended for a passive portfolio? Because I think in India we still have larger scope for active fund managers like yourself to really beat the underlying benchmark. So in that case, what allocation you think is ideal or acceptable?
So the answer you'll get from me could be significantly different from any other person in the market across fund managers and wealth managers.
Sure.
So it's more individual's choice. So I personally have more belief in putting money behind experts and instead of completely passive, but passive has become a very integral part globally of the overall AUM in the industry. So depending on individual's risk appetite, one can think of some allocation towards passive. But honestly, I'm not the right person. The person who is involved, like Karthik, you or any other wealth managers who deals with equity, gold, fixed income, and passive instruments, and even real estate and a lot of other venues can give you a better perspective in terms of, because he's not only dealing with equity, he's also dealing with other less risk products. So he can better guide this investor in terms of allocation towards passive. But I would say that passive as a product has gained significant traction over last decade. So some allocation could be justified towards these passive funds.
Sure. Thank you so much. So next question is to Shikhar. So Shikhar, suppose as an investor, if I have an SIP running with Groww, it's 500 rupees SIP. If I want to make it 1,000 in the same fund, what's the solution you recommend?
Yeah, as I repeat every week, this is a very popular question. So the solution remains the same, whatever we recommend every time, which is if you want to increase the amount, you can do two things, either of the two things. Number one is simply cancel the SIP, start a new SIP in the same fund with the higher amount, same SIP date, and so on. Or you could just let the current SIP run, and with the additional amount that you have, you could start a second SIP in the same mutual fund, same date, or up to you. That's it. There's no problem in having two SIPs in the same mutual fund.
Yeah. So will the incremental option on the cards? I mean, that's something which you're working on.
Yeah. So the problem with incremental is it requires a lot of there's a lot of work behind the scenes that needs to be done for that to become available. We are doing it correctly because there are some methods we can use to circumvent that, but we don't want to use any under table methods, underhand methods. So we're doing it correctly. It's going to take some more time for that to happen.
No, fair. Yeah, sure. Thank you. Let me take the next question. I think this is again a classic question which is generally asked every week. SIP or lump sum, which one is a better mode of investment? There's no comparison. SIP is like a necessity because from your regular monthly income, you're setting aside a portion of it and investing. That brings in discipline. So do continue your SIPs. But whenever you get lump sum, I think definitely do invest that as well. So do not treat both of them as same. Treat both the elements as two separate elements. At the same time, when you're investing lump sum, you could be probably a little more watchful of the market. If you think markets are expensive, then probably you can follow the STP strategy, investing that money in a liquid fund and entering into equity fund in over a period of time. I think that's the right way to do it. But don't confuse yourself. More the merrier. Be part of equity as long as your horizon is for long term. So next question is towards Mr. Mayur. So what's your take on small cap funds? I mean, where do they fit in terms of the allocation basket? And yeah, just your view on small cap funds.
So since we talked about passive fund, initially. Small cap is a complete other extreme. If I look
Yeah.
at the entire bouquet of funds, where the security selection becomes further more important. Like when I was talking about a focus fund, and I said that there is a great emphasis on security selection that becomes multifold when you're looking at the small cap fund. The individual companies in a small cap fund, the entry and exit is extremely difficult. And hence, the long term approach of investing becomes much, much more relevant when it comes to a small cap fund.
Yeah.
I'm just describing some of the characteristics. And because of the illiquidity in these companies, in these stocks, the overall risk, overall standard deviation of returns, you very often you find irrational movements where a good company where there are no problems, suddenly you see is down 20%. And people are questioning that why is it down? Right? So it's because of the illiquidity, you will very often find irrational movements in the stock price. So these are some of the risks in small cap funds. That's why you'll find the volatility around the returns, the standard deviation which you highlighted and the other parameters is always on a higher side. And if you're willing to take a long-term view, in generally investing in any equity instrument, you have to take a much long-term, furthermore, you have to go one step ahead and take a much more long-term view when you're investing in small cap. So that should be the first prerequisite. You should be mentally prepared that you're not playing for 1 year or 2 year, right? You're investing for a long term because it can surprise both sides. Number two, or definitely with all the risk which I explained, it comes with positives also. In a good cycle, and if you are with the right fund, with a good fund manager who has all the right ingredients in terms of investment process, investment philosophy, the risk management controls. So this kind of due diligence, I would say if you need to do this level of due diligence in equity, focus or any other category, in a small cap, it has to be 2x of that. The due diligence on the fund manager, the fund house, the investment process, framework, philosophy, and other factors. But definitely, if you are with the right small cap fund, some allocation out of your total bouquet of investments can give you much larger alpha over a long term. But again, the selection of the fund becomes extremely important. So you select fund A, small cap, and I select fund B. Over 5 years, the returns could be significantly different.
Yeah.
It's very much possible, right? So this difference could be much lower, maybe in a multi-cap fund or a focus fund. But this could be significantly different. And yeah, so small cap, take a long-term approach, do your own due diligence and arrive at the right selection of fund manager and stick to it for a long term. It should then definitely be a pocket of alpha in your portfolio.
Sure. Thank you. Yeah, I know it's a very tough question to answer. I know both are too extreme. One is index on one side, whereas small cap and sectoral funds on the other side. So next question is to you, Shikhar. I think every organization would love to have questions like this. For how long can I continue the SIP on Groww app?
Sure.
That's,
So,
yeah, that's one of the questions which a gentleman has asked.
So any SIP that you start on Groww, it is indefinite. It will go on forever till you cancel it. There is absolutely no upper limit. Once you start an SIP, it will run till you stop. So I know why this is happening. Many people, they look at, if you go on any mutual fund website app, not just ours, we have to show the 1 year, 3 year and 5 year return. And people tend to click on those and then think that the SIP is a maximum for that period, either 1, 3 or 5. But that has, what you see on the graph, the periods, that has absolutely no relation with the SIP you start. When you start an SIP, it will run till you cancel it forever if you want to keep it that way.
Sure. Thank you. So let me take the next question. This is one thing, safety and security when it comes to the matter of money is paramount, right? I mean, one gentleman is asking this question that, what is the safe amount of money to invest through SIPs and when you opt for moderate risk? Remember, um, every investment carries its own risk. That's why, even in the session when I started, I said, define your goals. What are those aspirations and divide them into three parts. Suppose you have a list of 10 financial goals. You would divide them into three parts: short term, medium term, long term. Anything which you are intending to achieve within 3 years, that's your short term financial goal. So that means even though your risk appetite itself is very high for that financial goal, ideally you should be investing only in debt portfolio or debt majority portfolio, right? So then selecting the right category of debt investments is also very important. At the same time, when you're looking at long-term investment horizon, say 7 years and above, there you should be aggressive. So it is like saying, you want to travel from Bombay to Pune, you would go by road. But at the same time, if you want to travel from Mumbai to Delhi, then ideally you should be taking a flight because it takes the shortest possible distance. But amongst all the transport, you would say walking is the safest mode of transport because you have all the controls in your hand. But you can't start walking to Delhi because you want to play safe, right? You have to take some element of risk there itself. So same logic applies to investments. The moment you think of long-term financial goals, you are giving, say, that 7 years, 10 years, or 15 years kind of horizon to the fund manager to invest in such companies which would really perform well in the long run. So go by your investment horizon. If it is long-term, then definitely invest in equity portfolio. So within that, if you want to play conservative, then like Mr. Mayur mentioned, maybe you could select some portion into say index funds, and then subsequently large cap funds and multi cap funds. Okay, that could be the kind of portfolio what you could construct if you're looking at long term. And what is the SIP amount? Try to do that basic math. There are so many calculators which are available. Put a value for the goal, say your children's higher education or maybe buying a house after that many number of years. Find out approximately how much money you'll have to invest every month. So that's the right way to approach on deciding the SIP amount as well. Okay. So that's my answer for the safer way to invest. Remember, safety is only a relative term. Okay. So let me ask. Next question is to Mr. Mayur. Markets like this, especially last 5 days with the way markets coming down, is this the right time to start putting in lump sum investments? What's your take, sir?
So 15 days back, I used to get the completely opposite question. The way markets are going up, is this the right time to invest?
Yeah.
And I said that, markets are going up. Valuations are definitely going above the last 10-year mean. And some bit of discomfort has started getting built in. But the thing is, we are looking at next 3 years, where currently we are looking at a cyclical rebound in the economy. I'm just highlighting the word rebound. And there are hopes, I would say, not with very high conviction, because it depends on what government policies are, coming out and things like that. There are hopes of this cyclical rebound getting converted into a cyclical recovery, a much more sustainable recovery. And in that case, even from here on, we do see decent amount of upside in the market, but over a long term, next 2 to 3 years. But what will happen over next 1 month, 2 months, and 3 months, only God knows. If anyone is guiding you on that, I think you need to be pretty cautious. So after a very strong rally, we are seeing some correction in the market. But I would suggest you spread it out over next maybe 3 to 6 months time, and having SIP of course, the way Karthik explained, it's always the best thing to do. And especially when you staring at a very good 3 years in terms of the cyclical recovery, it makes sense to increase exposure to equity, but again with a long-term view. So just reminding everyone, going back to the same slide which I discussed about the time, volatility, and returns, where you could have invested at any point of time over the last 20 years, where we have seen huge drawdowns and also we have seen sharp rallies, but there are 50% probability you had of, getting decent returns. So to cut it short, I think if I would say you spread it out to avoid to ride through the current volatility with a 3-year, 4-year view, I think it makes sense to increase weightage to equity.
Sure. So thank you so much. I mean, to add to what Mr. Mayur is saying is, see, everyone has a role to play. Your and my job is to save that money, save it hard, and then invest in the basket of funds, and leave it to the fund managers on identifying the market opportunities, and then invest and create a nice portfolio. The moment we start doing their job is when I think we are chewing more than what we can really eat, like, so don't really try to time the market. Let's have the discipline in investments, and then stay invested. As long as you're in being part of that systematic journey, then I don't think you should really worry about 50,000 or 46,000. I think these are all just numbers in the portfolio journey, what you would have seen. So let me take the next question. What are fund of funds? A very interesting concept. See, today when you invest in a particular mutual fund scheme, they invest in a pre-decided theme or based on an investment objective, a large cap fund or a multi-cap fund or whatever fund so far. If you're intending to invest, say 500 rupees or 1,000 rupees, then you just have to select one scheme. You may not be able to be part of the journey of, say, 4 or 5 different schemes. So instead, if there is an option where you invest money into one particular fund, that is, it's called as fund of fund, whatever money they collect, they invest in maybe 4 to 5 different mutual fund schemes. So the portfolio of fund of fund consists of different mutual fund schemes, not the stocks or any other securities directly. So such a portfolio could be, I'm not saying not all the time, it could be a combination of large cap, multi cap, and mid cap, and so on, depending on different strategies what fund managers would follow. So imagine with that 500 rupees what you're investing, you having a portfolio of 5 mutual fund schemes. And then you're not dealing with 5 funds separately, you're just investing in one fund of fund. But the only caveat what you need to understand with respect to fund of fund is, from the income tax treatment point of view, when you are invested in fund of funds, it would still be treated as debt as per the taxation. You will not get the equity benefit of taxation. So that's the only drawback as of now with respect to fund of funds in India. We are hoping that would get fixed in the times to come. Okay. So let me, let's say, take up one last question. I think everyone who is reading a little bit of markets also have this basic understanding or phenomena that markets valuations are very high. And the most common factor what we look at for market valuations is PE ratio. I think in our lifetime, we would have seen this kind of PE ratio for the first time. What do you make out of this, Mr. Mayur? What's your take on very high PE running in, be it in Nifty or Sensex? What should we do in times like this?
See, there is one thing I want to highlight, that market is always forward-looking. So when you are trying to analyze different parameters related to the market, you also have to think forward-looking. So normally people do this mistake of just looking at the trailing earnings of Nifty and trying to see what is the P multiple in terms of the valuation. As we speak, the trailing earnings, because of the COVID and the pandemic which we have seen, has been impacted severely and distorted. So this is not giving you a true picture, right? So the kind of demand recovery we are seeing over last few months, that picture is completely different if you try to paint a last 12 months average or last 12 months picture in terms of earnings. So what I'm trying to say is, when you're looking at a P multiple, you have to look at how things are currently and how next 1 year is going to pan out, right? And if you look at every fund house and the brokerage and research houses will have their own estimates based on their views on certain sectors, economy, and things like that. But if you look at next 1 year, FY22, the year ending March 22, most of the strategists, even we would have somewhere closer to that, is looking at a 30% growth in earnings expected. These are estimates. I'm just reiterating that. And hence the P multiple is nothing but the price of the Nifty divided by the earnings, right? Once you look at forward, which is where the market is looking, that PE multiple looks much lower. So, but still on a 1 year forward basis also, if you look at the current PE multiple and compare it with last 10 years mean, it is still around 20% plus higher than the last 10 years average, which clearly says that the valuation is on a higher side. But the point I'm trying to make is, from here on, there is a there is a hope of the cyclical rebound getting converted into cyclical recovery, right? Forget about COVID. Even before COVID, till December, November, December, before COVID, we were staring at a very weak economy, right? GDP growth coming down from 6% plus to around 5% and below, and things like that. So the last 5 years have been pretty modest to below average in terms of the economic growth, I would say. And a lot of segments, a lot of sectors have underperformed in terms of growth. And then this pandemic has happened. So on this base, there are a lot of things which are panning out in terms of positives. The interest rates are down around closer to 150, 200 bips. In terms of housing, you are seeing demand picking up. You are seeing, say, for a 10 lakh housing loan, 2% reduction in interest cost for a 15-year tenure. Roughly, you would find a 10,000 plus savings in terms of your monthly EMI, right? That's a big boost. So these are some of the positives which are already reflecting in the economy, right? So heading into that, it's very difficult to take a chance that getting into, if the cyclical recovery becomes sustainable, why do you want to get off the ride just because we are on a higher side of valuation? But again, it's a function of earnings, and as earnings gets upgraded, the PE ratio can look even better going forward. That's my thought around this.
Sure. Thank you so much. Thanks for all the insights, Mr. Mayur. It was really great having you on our show today. Thanks, Shikhar. So thanks everyone for being part of this. So have a great day and have a great weekend ahead. Thank you so much.
Thank you, everyone. Thanks for patient hearing. Have a great weekend.
Thank you, everyone.